Good day, ladies and gentlemen, and welcome to our video, our class on understanding and interpreting trend patterns. The trend patterns are different than chart patterns or trading patterns. These are how to recognize what a trend is trying to tell you. And it's necessary for trading in Forex, commodities, stock, cryptocurrency, for all CFDs, ETFs, and more. Now, I would appreciate it greatly if you would click on the subscribe button and subscribe to my YouTube channel. I promise you, we don't contact you for anything. You'll just get a notification whenever I upload a new video to YouTube. So please click on the subscribe button. So let's move forward, understanding and interpreting trend patterns. Now, trend patterns include a lot of variations that most of us heard the words: retracements, reversals, continuations, and breakouts. Now, a pattern is a series of data that repeats in a recognizable way. It can be identified in the history of the asset being evaluated or other assets with similar characteristics. Patterns often include the study of sales volume as well as price. So in other words, these patterns aren't just some one-off thing here and there. These are patterns that appear in the history or in the journey of an asset. And again, we have continuations, we have reversals, we have breakouts, and understanding and recognizing them and noticing them when they're going to happen is very important. Patterns can occur within a downward and upward trend or as marking the beginning of a new trend. There are bottoming, topping, and continuation patterns. A follow-through day pattern is used by some analysts to identify market bottoms, and the head and shoulders topping pattern is popular among day and swing traders. Continuation patterns include the cup with handles, flat base, and 3-week tight patterns. But these are patterns, chart patterns. We're going to be talking today about trend patterns. Now, one of the easiest ways to see or notice these trend patterns is in a combination with Fibonacci retracements, because Fibonacci retracements will help us see when a retracement is happening or perhaps it is a reversal. Simply put, using this strategy or this tool can help you determine which direction the trend is about to move. So what exactly are retracements? They are price reversals that are produced temporarily within a larger price movement. Their most important feature is that they do not last for long before price resumes its original motion. So keep in mind, price moves in push and ease, push and ease, push and ease. Price doesn't move straight up. These pushes and eases can be determined or noticed as they are retracements, because they only take a short while to happen, or they only happen for a short while, and then the trend will resume in the direction in which it was moving. Now, retracements do not produce large increases in trading volume. In contrast, major reversals are generated by the intense selling of professional bodies. Retracements do not generate many notable chart patterns, and the ones they do mainly are limited to a few minor candlestick patterns. Reversals are very serious events and can create numerous well-known chart formations. But remember, a retracement is a push, ease, push, ease, push, ease, whereas a reversal is push, ease, push, new trend. The prior trend reversed itself. Now, retracements are temporary and do not normally last longer than a week, or in our type of trading, usually don't last more than an hour or two. Reversals have much longer time spans and may last for weeks, if months, if not months. For us, they usually last a day or two. It depends on the time frame in which you're trading. Retracements are created shortly after large price movements have been initiated, while reversals can occur at any time. Now, retracements are temporary price reversals that take place within a longer term trend. The key here is that the price reversals are temporary and do not indicate a change in the larger pattern. So this is what is defined as a reversal. So when price is moving up or down, depending on what's happening, and then reverses, okay, and then continues back up, that is a retracement. And this occurs within a healthy price movement. A good trend is a series of push and eases, push and ease, peak and valley, or as we know them in technical terms, higher high, higher low, higher high, higher low, higher high, higher low. And then when it eases off that and then begins making higher high, higher low, higher high, higher low, we know where you are in a retracement. And noticing and understanding and knowing it's a retracement, number one, will keep it in a trade longer and let us take advantage of a much larger move, and will keep us from panicking and jumping out of a trade. Or if we're looking at a point to enter, when we see this retracement and then verify that it was a retracement, it's a great place to enter a trade. Now, there are technical defined ways that we can put on these retracements or reversals, like volume. Volume actually happens with profit taking from retail traders, because if you're looking at price was being pushed up, pushed up, pushed up, or pushed down, pushed down, pushed down, what happens is at some point, a lot of traders start taking a price. The other traders had set on the move to the side of the market because they said the price was getting too high. The price eases down. The sellers get out of the market. The guys who moved to silence, now we're at a good price. We're going to jump in and buy the market. And that forms the retracement. A reversal is usually when the big institutional guys start jumping out of an asset. Now, we have money flow. We have chart patterns. For instance, few if any reversal patterns usually, and they're usually limited to candlesticks. And then in reversals, we get a lot of reversals like double tops, double bottoms. Okay, when we're looking at chart patterns to see and define a reversal. Now, Fibonacci retracements were designed to forecast the scope of a correction when trends are prevalent. The most common retracement levels used to achieve a goal are 61.8, 50, 38.2. And these are very important because these will help you see if that's really, or define whether it's really a retracement or a reversal. Now, the 50% retracement level is one that is used and is a key area to buy in uptrends or sell in downtrends. Now, 50% is not a Fibonacci number, but because it's such a popular retracement, we put that on our charts along with the Fibonacci levels. Now, Fibonacci retracements were designed to forecast the scope of corrections when trends are prevalent. The most common retracements are at 61.8, the 50 I just told you about, and 38.2. Okay, when using the Fibonacci retracement tool, we can help determine what that trend pattern is. Is it reversing or is it retracing? Now, why is it so important to distinguish between retracements and reversals? Well, this is because traders must contend with difficult decisions whenever a reversal occurs. For instance, should they hold the position open but risk a serious loss? Alternatively, should they sell at the first sign of a price drop and then rebuy at a more favorable discount? However, they have the risk of the chance of losing larger gains if the prices suddenly surge back. They have the cost of a spread, so you have to pay to sell and have to pay to buy. And then you'll miss the bigger moves, because when you think that if you were ending the euro 116.5 and you thought it was going to go to 117.4, and that's a nice trade for you, and when it got to 116.40, say 54, it started a small retracement, and then you jumped out, you made virtually no money. But if you would have stayed in through that retracement and let it move up, because then after a retracement you usually get a nice push. So why is it so important to distinguish? Well, or how do we distinguish? Common technical indicators that are used to monitor retracements are Fibonacci retracements, trend levels, and support and resistance and pivot points. Retracements usually occur after huge price movements, whereas reversals can occur at any time. Retracements are short-term and short-lived, where reversals are usually long-term changes. Reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend, a reversal occurs. When a downtrend switches to an uptrend, a reversal occurs. Using the same examples, here's what a reversal looks like in an uptrend. Pushes up, we might see some chart patterns here. We might get a bearish engulfing, or you might have a support or resistance line, or actually in this case a resistance line. The price bounces off. But how do you know it's not just one of these common retracements? And how do you determine that it actually is a reversal? Because if you would have stayed in here and waited for this point to see if it's going to bounce back up, you would have lost a great deal of the profit you would have made on a trade. So how do you know when we are looking at a reversal? Well, when a price reverses, most traders and investors are faced with tough decisions. They have three options. One, hold through the sell-off. Two, sell and rebuy. Three, sell permanently, get out of the market. Okay, the problem is, where do you sell and get out of the market, or where do you come back in? By properly identifying the movement as either a retracement or reversal, you can reduce costs, limit loss, and preserve gains. When faced with the possible retracement reversal, you only have those three options. Now, you could close permanently. For me, that's what I do. If I see a retracement, I let my money fly. Okay, as long as I can assure myself it's a retracement. When it gets a little bit steeper, for me, when it gets below a 50% level, I'm out of the market because I can always rebuy. And if I'm making profit, I'm going to book my profit. I'm going to be happy and just walk away with what I got. Now, because reversals can happen at any time, choosing the best option isn't always easy. Therefore, using trailing stop loss points can be a great risk management technique when trading with the trend. Now, continuation patterns. Technical analysts and traders use the term continuation pattern to describe seemingly random price movements that can be interpreted to mean a current larger trend is likely to continue. There are both bullish and bearish continuation patterns. Any given pattern is not considered complete until the price has broken out. So no matter what you read about triangles, wedges, head and shoulders, until you actually have the actual real breakout, you don't know anything. Okay. There are plenty of false breakouts and an apparent pattern that form but still lead to the trend reversal. Also, despite their widespread appearance, continuation patterns are still somewhat subjective. To combat possible false patterns, traders use other technical indicators and even fundamental analysis to help confirm a forming continuation pattern. Breakouts. Now, I'm a breakout trader. I trade from basically support and resistance and chart patterns, primarily triangles, and then price action. Sometimes prices vary within a range, such as a channel or the formation of a triangle. A breakout occurs when prices are no longer contained in a range. Now, since we're talking about interpreting trend action as opposed to chart patterns today, okay, because we have whole classes on chart patterns, let's talk about this. The more developed your trend is, In other words, the prettier the trend line is. Okay, the higher quality the trend line is, and the more precise your trend is acting and reacting to support and resistance levels, triangle patterns, and breakout patterns. The more it's reacting to Fibonacci, the better your trade is going to be. Now, you can always find a trade. You can always make things work. If you spend your time looking for high quality trends and then well-developed patterns and excellent support and resistance lines, you will find you have high probability trades. Just because something is jumping between support and resistance and looks like it's going to give you a beautiful breakout, if you don't have a well-developed trend and high and good support and resistance lines, what you do is have just a whole bunch of coincidences. In practice, a breakout is most used to refer to as a situation which the price breaks above a level of resistance and moves higher, or below a level of support and moves lower. Price resistance occurs when an excess level of supply of a particular security accumulates at a particular price level and creates a glut in supply that overwhelms demand and impedes the upward movement. Once the market absorbs the surplus level of supply, resistance is usually breached, with a sharp upward movement resulting from these abrupt shifts in supply and demand. Trading breakouts is best done when the prevailing market condition is either up, trending, or range bound, with price action approaching the upper level of the range in a well-developed pattern. Once a resistance level has been identified, volume should be monitored very closely. Volume can help you make the best determination